Welcome to this Killik Explains finance video. This week, Brexit, 5 lessons for investors so far. Now, where are we so far? Well, the backdrop is this. Theresa May recently spelled out her 12-step vision for what's being called a hard Brexit. That means the UK will endeavour to achieve a more or less complete break in economic and trading terms from the EU and single market and then re-establish those relationships almost from scratch. The formal Brexit process will, it now seems, need parliamentary approval. But what does all this mean for investors? Here are my 5 lessons so far and then some takeaways at the end. Lesson number 1 then, don't get hooked on media noise. Over the next year or two, Brexit will continue to generate lots of media comment, lots of speculation. The pound and the FTSE will probably remain very volatile. Partly as a result, we've tended to see the pound falling, the stock market rising and vice versa. This isn't particularly relevant to long-term investors, however, and I'll reinforce some of our key investing messages at the end. So there's lesson number 1. Lesson number 2. Investing isn't all about Brexit. It's easy to believe that all that matters at the moment to a UK investor is our relationship with Europe. But actually, the UK and Europe will continue to worry and that will dominate the headlines, but other things matter as much. The current account deficit, for example, that is our trading overdraft with the rest of the world. That was huge before our decision to leave the EU was taken, and that continues to worry investors quite correctly. Then there is the possible return of inflation after a period of low inflation and, in the case of Europe, deflation. Those two things you should keep an eye on, and they're fairly close to home and could have an impact fairly soon. Globally, the health of the US, that's the biggest economy in the world, and China are also critical to everyone's well-being as international diversified investors, for example. So keep an eye on those two. Don't become obsessed with what's happening here and what's happening between us and Europe. Number 2. Number 3, the past is not a reliable guide to the future. Now that's a classic risk warning if you buy shares. Why am I bringing it up here? Simply because things are moving fast at the moment. Last year, the UK was apparently bottom of the pile. That was the expression used in terms of getting any new trade deals agreed with other major trading nations. Then Donald Trump stepped in recently and almost said that's not true, but backed away and basically hinted that we are not bottom of the pile anymore. So all we know is that this is a huge period of change, something on the scale of Brexit has never been tried before. Do not make assumptions, because what was true 3 months ago, 3 weeks ago, or even yesterday may start to change as we see politics roll through Europe this year. Lesson number 4, expect the unexpected. What do I mean by that? Well, basically a weak pound is a currency market barometer. It's saying we don't like the look of UK PLC, and yet we've seen since the decision to Brexit was taken last June, the FTSE, the stock market in the UK, rise sharply and other stock markets have climbed too. So the doomsters so far have not got things right. Everyone thought that a decision to Brexit and so on would lead to a collapse. Donald Trump's election would lead to a collapse. Well, so far we haven't seen that. So expect the unexpected just means do not draw conclusions from the doomsters who are out there saying that everything is going to go wrong as a result of some of these key decisions. Lesson number 5, experts are not to be trusted. Now, what do we mean by that? Well, economists got the financial crisis wrong basically 10 years ago, or nearly 10 years ago. All right, they failed to see it coming, failed to see the scale. Those same economists basically have not really got the effect of Brexit and the election of Donald Trump correct so far, in stock market terms at least. And Brexit has never been tried before. So anyone who says, I will tell you how things will pan out over the next year or two, is not really telling the truth, because a country the size of the UK has never attempted to leave a trading bloc the size of the EU in living memory. So be careful trusting experts. Now, what to do in practical terms? I would suggest do not change your strategy as a result of whatever happens as a result of these Brexit negotiations over the next 2 years or so. So regularly monitor your asset allocations against your long-term investment objectives. Don't be blown off course by short-term news. Factor in the possible return of inflation. Now, nobody knows whether that's a short-term blip or more of a long-term trend, but you've got to start thinking about it as an investor, I would suggest. And diversify internationally to reduce country-specific political risk. In other words, there is risk between the UK and Europe. There's risk all around the rest of the world. Diversification will help to reduce the impact in currency and political terms. Invest into themes that are not hostages of specific country risk. Big global themes leave you less vulnerable to specific localized issues. Don't let gloomy headlines force you out of stocks and into cash, Anyone who took that route early in 2016 will be down something like 30%, just looking at the UK's main market as a catastrophe. And cash, yes, it's safe in the short term. Yes, it's good for a rainy day fund, but its long-term performance is pretty dire compared to other asset classes. And reinvest dividends is a good idea as you build your wealth in equities to reduce volatility. And also, if you're nervous right now, do consider drip feeding into the market rather than dumping in a lump sum all at once. So there you have it, a quick tour of what we know from Brexit so far from a sort of practical how-to point of view and some tips. Any questions? editor@killik.com, and to see related videos, please go to killik.com/learn.